Excellent investment decision is based on research. The more you research a given stock, the more you come up with a more reliable decision-making process. So in this video, I want to highlight how to research stocks, kind of a step-by-step guide. When it comes to researching stocks, we have to consider number one, you define your investment goal. You know, what is your target? What are your objectives as it relates to the investment you want to carry out? So you have to determine your objectives. Is it income? Is it growth? Is it value investing? Is it growth investing? Whichever one. So you set a time horizon, and of course, you determine your risk tolerance. What is the length of time I feel I will use to be able to obtain my desire, my objective? Is it 3 years? Is it 5? Is it 7? Is it 10? Is it 15 or 20? So you determine precisely your investment horizon. And also, you take into consideration your risk tolerance. It could be moderate, it could be aggressive, it all depends on individual factors. Probably biology, I don't know, but you need to determine your risk tolerance. And of course, the risk tolerance tends to vary with age. The older you become, the more, the less risk tolerant you have. Number two is understand the company. So you study the company's business model, you study their product and services, you analyze its competitive position, what we call the moat, how competitive is the business in its industry. You take all these factors into consideration, fully understand the market, the company you want to invest in, have a thorough knowledge of what the company does, its depths when it comes to industry performance, its leadership in the industry, its moat, its competitive advantage, and other related factors. Number three is that you review the financial statement. You consider the company's income statements. In this case, you consider revenue and profit margin. You equally look at the company's balance sheet, its risk and liability, as well as the equity and the debt level. You equally take into consideration the cash flow, statement. You talk about, operating cash flow, as well as on the free cash flow. So these three statements are very important: the income statement, the balance sheet, and the cash flow statements, because these are what determines the health, the overall health of the company you want to invest in. And that is something I must emphasize. When it comes to investing, you need to have a basic knowledge of accounting. Personally, I did engineering, mechanical engineering, but when it comes to investing, I have to talk like an like an accountant. I had to learn a little bit of accounting over the years, because you will not be able to analyze a company without a decent knowledge of basic accounting. Number four is evaluate key financial ratios. You consider profitability ratio, that's net profit margin. You talk about return on equity. You consider valuation ratios, and this has to do with the PE ratios and price to book ratios. You consider the liquidity ratio, and this has to do with current ratio as well as a quick ratio. And you equally take note of the debt ratio. In this case, you talk about debt to equity ratio or the interest coverage. So all these ratios are very important. You understand them, because this will serve as a guide to the company you want to invest in. So you consider all these key financial ratios. These few are enough. These basic few are enough for you to be able to make a reliable investment decision. Number five is understand the industry. You don't just focus your attention on the stock, the individual stock you want to buy. You equally understand the industry and the stock or the sector the stock is operating in. So research industry trend, the growth potential for the industry, and of course the competition within the industry. So identify economic and regulatory factors that could impact the industry one way or the other. You take all these things into consideration. Number six is analyze growth potential. When you buy stocks, you don't just buy stocks for the present. You consider the growth potential of the stock in the future. You review its historical performance and equally take into consideration the possibility of a decent growth in the future. So examine the company strategy for innovation and market dominance or expansion. Ask yourself, what is the company putting in place so as to be able to grow at a decent clip, at a decent rate in the future? What are the strategies it wants to employ to be able to expand its market share? So you take all these things into account. Number seven is study market sentiment. You study market sentiments. So you monitor market news. You also consider analyst report, analyst opinion, and market trend. You use tools like Google or Yahoo Finance. You have sufficient information that relates to the company you want to invest in. You look at prevailing sentiments that could affect the stock price, and you equally consider news analysis and analyst opinion or reports that could have a bearing on how the stock is viewed by the majority of investors. Number eight is you assess management quality. These companies are being led by a team, by individuals that incorporate the management team. So you assess the quality of the management team, based on the experience, their vision, and their track record. Look for transparency and alignment with shareholder values. Is the management team there to serve themselves or to serve the shareholders? You ask yourself that question. How shareholder friendly, are the management decisions? You also consider all these things. Number nine is analyze dividends if applicable. Check for dividend yield, the payout ratio, and regularity, as well as industry growth. Of the company paying dividends, are the dividend aristocrats? What is the payout ratio? And how consistent are they in paying dividend? And has the dividend been on the increase year in, year out? You consider all this. Please don't forget to subscribe to this channel and like this video if you've not done that. Number 10 is understand risk. You understand company specific risk or industry related risk or even macroeconomic related, even macroeconomic risk as it relates to the company. You take all these things into consideration. Assess potential volatility and downside scenario. What kind of risk is the company actually passing through? What level of risk is the company being exposed to? And how can that affect the company in the present and even in the near future? You analyze, you understand, relevant risk as it pertains to the company whose stocks you want to invest in. Number 11 is you carry out, peer-to-peer comparison. You compare the company with its peer. You benchmark the company's performance with other companies in the same. It must be in the same sector, please. Don't compare companies from different sectors. No, pick a sector and you compare the company, even which shares you own in the same with other companies in the same sector, a kind of apple to apple comparison. Number 12 is you use valuation models. You could use models like discount cash flow or dividend discount model to estimate intrinsic value. You know, although personally I've not used discount cash flow before, and I've not used dividend discount model. I prefer using the company's financials as well as valuation ratios, as well as financial ratios. That's what I tend to like specialize in. All these other ones are like futuristic and may not be very accurate when it comes to discount flow, discount cash flow, analysis. You want to see the amount of cash the company will make and then discount it into, I don't do that. Number 13 is, you track historical performance. Although they say that past performance is not indicative of future result, but all the same, a company that did well in the past is more likely to do better in the future than the ones that did poorly in the past. Though it is not a rule anyway. Variations can equally occur. So you track, historical, analyze past, stock performance, including trend during market highs and low. You analyze how the company performs. Look at the charts. Company chart. Is it going like this? Or is it going like down? You consider all the, though you may be an investor, but you could put these elements of trading, what traders equally consider. So number 4 is make an informed decision. Make sure that your decisions are actually based on solid fact, not on sentiments. All right. And then you decide based on qualitative as well as quantitative factors, not based on sentiments, fear, or greed. Number 15 is monitor your investment. Don't just buy and go to sleep. Monitor the performance of your investment, and if possible, you rebalance your portfolio whenever necessary. Rebalancing here means buying more of what is doing well and selling more of what is not performing very well. So by following these steps, you can develop a structured approach to stock analysis and make more informed investment decisions as a result of what you've learned. It's very important as an investor. Without this, you may not be able to consistently make profit in the market. You just be investing almost like blindly. You need this basic accounting to be able to invest profitably.